Welcome to Evangeline Ed Academy. Today, we are going to study about cash flow forecasting and working capital, Chapter 5.2 IGCSE Business Studies. Cash flow forecasting and working capital. Introduction. Understanding and managing cash is perhaps the single most important financial task for any business, especially new ones. This section covers why cash is important to a business, what a cash flow forecast is and how to use it, how to solve short term cash problems, the concept and importance of working capital. Your learning goal, you will be able to explain the difference between profit and cash and use a cash flow forecast to manage a business's liquidity. Why cash is important? Cash versus profit, a critical difference. Profit is the money left over from sales revenue after all costs have been subtracted. You can make a profit but still fail if you don't have enough cash. Cash is the money readily available in the bank or in hand. Why cash is vital? Paying debts. A business needs cash to pay immediate expenses such as wages, suppliers, rent, and utility bills. Failure to pay these debts means the business is illiquid and can face closure or bankruptcy. What is working capital cycle? Cash allows the business to buy inventory, turn it into sales, collect the money from customers, and repeat the cycle smoothly. Taking opportunities. Having surplus cash means the business can react quickly to opportunities such as buying materials in bulk at a discount or fixing broken machinery immediately. What is cash flow? Cash flow is the movement of cash into and out of a business over a period of time. Positive cash flow occurs when cash flow inflows are greater than cash outflows. Negative cash flow occurs when cash outflows are greater than cash inflows. Cash inflows, receipts. These are the main ways cash flows into a business. The sale of products for cash, immediate payment from customers. Payment made by debtors are the money collected from customers who purchased products earlier on credit. Borrowing money from an external source. Cash inflow from bank loans, mortgages, etc. The sale of assets of the business, that is, selling unwanted non current assets like old property or old equipment. Investors putting more money into the business when new capital is injected by the owner or shareholders. These are all cash inflows. What are cash outflows or payments? These are the main ways cash flows out of a business, like purchasing goods or materials for cash, that is, paying suppliers immediately for inventory or raw materials, paying wages, salaries, and other expenses in cash, which is covering operating cost, purchasing non-current assets, that is, buying long-term assets like new machinery, vehicles, or buildings, repaying loans, making regular payments on borrowed money, paying creditors of the business, settling debts owed to suppliers who provided items to the business earlier on credit. Here is a cash flow cycle. Cash needed to pay for raw materials, wages, rent, and other bills. Goods and services are produced. Goods and services are sold. Cash is received for the goods and services sold, and again, cash is needed to pay for buying raw materials. What is a cash flow forecast? A cash flow forecast is an estimate of the expected cash inflows and cash outflows of a business over a period of time. The formula for a net cash flow is total cash flow inflows minus total cash outflows. Closing balance equals opening balance plus net cash flow. Here are the components of a cash flow forecast. Opening balance. It is the amount of cash the business has at the start of the period. Cash inflows are money coming into the business. Cash outflows are money going out of the business. Net cash flow is the difference between the cash inflows and cash outflows for the period. Closing balance is the amount of cash remaining at the end of the period, which becomes the next month's opening balance. What is the importance of cash flow forecasting in a business? This is a crucial planning tool for several reasons, which is identifying potential shortages. It highlights months where the net cash flow is negative and the closing balance is low, allowing management to take actions before the crisis hits. This is supporting loan applications. Banks require forecasts to ensure the business is viable and can repay any loan it requests. Controlling operations. It helps managers keep costs in check and encourages the timely collection of debts from customers. Planning for surplus cash. It shows when the business will have surplus cash, which can then be used to pay off loans, pay dividends, or reinvest in the business. How does the cash flow forecast help the manager? It tells the manager how much cash is available for paying bills, purchasing fixed assets, or repaying loans. It tells how much cash the bank will need to lend to the business to avoid insolvency, whether the business has too much cash that can be put to a profitable use in the business. Cash flow forecast. Opening balance is the cash available at the start of the month. Inflows is money coming into the business. Outflows is money leaving the business. Net cash flow is inflows minus outflows. A negative number in brackets indicates a net deficit for the month. Closing balance is opening balance plus net cash flow. This figure becomes the opening balance of next month. Interpretation and amending of a simple cash flow forecast. Let's do a net cash flow analysis. Look at the net cash flow row. In February, it is $1,000. This is the amount of cash lost during that month because it is in brackets. Closing balance analysis. The closing balance for February is $700, which is a deficit. Conclusion. A negative closing balance indicated by brackets or a minus sign means the business is illiquid, it cannot pay its bills, and will need an overdraft or urgent intervention. The crisis point here is February. How to overcome short-term cash flow problems. Number one, solutions for negative cash flow is if the forecast predicts a shortage, managers must take action quickly. Number two, securing a bank overdraft. This is the quickest way to cover a temporary negative balance, allowing the business to continue making payments. Number three, delaying supplier payments. Negotiate longer credit terms with suppliers. This increases the immediate cash available, but be careful not to damage the business's relationship with its suppliers. Number four, asking debtors to pay more quickly. Offer a small discount to customers who pay their debts immediately instead of waiting for 30 to 60 days. This speeds up cash inflow. Number five, reducing current outflows. Cut back on non-essential spendings like maintenance, advertising for the short term. Selling unused assets. Selling old unwanted machinery or vehicles for immediate cash. What is working capital? Working capital is also known as net current assets, is the finance available for the day-to-day running of the business. The formula to calculate working capital equals current assets minus current liabilities. What are current assets? Items the business owns that will be converted into cash within 12 months, example inventory, stock, debtors, cash, etc. What are current liabilities? Debts the business must pay within 12 months, example overdrafts, creditors or suppliers, and short term loans. How important is a working capital for a business? Number one, sufficient working capital means the business is liquid and can meet all its short term financial obligations. Insufficient working capital, which is current liabilities being more than the current assets, means the business is illiquid and cannot pay its short term debts even if it is profitable. It's the lifeblood of daily operations. Conclusion and review. What is profit? Revenue minus cost is profit. What is a cash flow? The movement of cash in and out of the business. What is a cash flow forecast? An estimate of future cash inflows and cash outflows. What is net cash flow? Inflow minus outflows. What is a working capital? Current assets minus current liabilities, the lifeblood of daily operations.